Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us. It's great to have you all with us today. Our goal with FounderLine is to give people a way to get their questions about startups answered by experienced entrepreneurs and investors. Maybe you're thinking about starting a company. Maybe you've already started a company and you have an issue that you're working on at your company. You might be someone who just got a job offer from a startup and you're trying to decide if you go join the company. Whatever it is, we'd love to try and help you today. The way this works is we can only be successful if you interact with us, if you send us questions. We've already gotten quite a few today, but we need more. So you can do that in a number of ways. You can go to our website and read all about it there. But the easiest ways are email to help@founderline.com, or you can tweet to our Twitter handle, which is @FounderLine, and we'll see if we can get your question answered today. With that, let's get started. Our guest today is Mike Maples, who's a founding partner of Floodgate Fund, which is a seed venture capital firm here in Silicon Valley. Mike's been a founder and executive at back-to-back startup IPO companies, Tivoli Systems and Motive, and he's been an investor in a bunch of startups that you've heard of, including Twitter, Twitch, and Chegg. Mike, welcome, and thanks for joining us today.
Thanks for having me.
Great to have you here. Before we dive into, we got a bunch of questions piling up here, but I usually just like to warm up a little bit, ask you a few easy ones that hopefully you know the answer to.
Easier the better.
Yeah. Your middle name.
That's right.
So let's start with that. One of the things that I thought was really interesting, and you probably don't know this, but we share something in common, which is we're both part of back-to-back IPO companies in our careers, which, looking back on it, I really didn't understand how hard that was and how lucky I was to have stumbled into, or educated stumbled into. Those are amazing processes that we both got to go through, and maybe you can talk a little bit about what that was like in the early days of your career, working in those companies on the way to an IPO, and then how sort of the startup world has changed in the years since that happened.
Yeah, well, the first IPO I was part of was Tivoli, and it just all happened so fast, it was kind of a blur.
Oh, yeah?
And everybody was so excited. I remember we all went, the whole company could still fit in the biggest conference room. And
wow,
so
like
we
20
were there.
people? Or?
No, it was probably more than 100, but it was like the training room, it was a bunch of stuff, button tables and stuff. We cleared them out. Everybody was drinking champagne and mimosas, and Frank Moss was on the stock exchange floor talking about what was happening and explaining how the trade was occurring. And he said something at the time that really resonated with me, which was, maybe we'll succeed, maybe we won't in the long run as a company, but the IPO event is kind of something that no one can ever take away from you.
Exactly.
You probably, and now with some time in the rearview mirror, you realize that not everybody gets to go through that, and it's just a really special and exciting experience. And so when we started Motive, I said my only request is that if Motive goes public someday, that I get to be there on the NASDAQ exchange the day that it goes public. And so I got to see the other side of it.
I never got to do that, so that's awesome.
It's just incredible, like you're sitting there and you're in New York and you come up on the NASDAQ floor and everybody claps, because you're the founders, and you kind of go in, and then I remember there was this trader sitting up to these terminals, and he says, "Motive in 30 seconds." And I remember just feeling like, wow, this is real.
Yeah.
And then just bam, the trade started happening, and the ticker signs.
And hopefully
up there.
It was priced above.
It was, fortunately we did pretty well. But back in those, Motive went public in 2004, and the only companies that got out that year were like Salesforce.com and Google and folks like that.
Awesome.
So it was a miracle to survive the dot-com meltdown and come out on the other side and tell the tale.
It's awesome, and I've seen that recently with friends who've gone through. There's like a couple IPOs every day, it seems, right now. So the window is clearly open, and it's such an amazing experience. Even now, they've got the they've got the bring the company in route down, like, you know, they bring them to Wall Street and they, you know, they get the photos outside, you know, and some are now NYSE as well, right? So
and we drove the taxi up to Times Square, so you see the big Motive IPO sign in Times Square, and then it's like you zip to the airport and you catch a private jet back so that you have time to celebrate with the rest of the company.
Exactly, yeah, because I remember that, like, the founders felt a little guilty. It's like, hey, we're out here, and like all those guys are, you know, back there in the office. I mean, it's still a pretty amazing,
pretty awesome
thing. So, so what's changed since then? You know,
well, I think that the main thing for me has been just the costs of trying an idea have just collapsed. And so when we started Motive, you basically had to buy an Oracle database, and you had to hire a PR agency, and you had to host it on Solaris servers in the Exodus data center.
That's right.
And it was just kind of $5 million just to hit the go button.
That's like early 2000s, right?
Yeah. Well, this is like late 90s for us.
Oh, okay.
Yeah. But like when I moved out to Silicon Valley in 2005. I used to like to joke that 500,000 is the new 5 million, and probably even less than that now.
Right.
But it was very clear that even though it costs money to scale a company still, the cost to prove or disprove an idea had gone way down. And so my view of that was that the venture capital landscape was going to change in response to those changing conditions of startups.
And that led to
Floodgate.
Awesome.
Yeah. So that's, you know, it was kind of necessity was the mother of invention. It's hard to believe now. In 2005, you couldn't raise $1 million in Silicon Valley. You know, you could either scare up a few $100,000 from angels or go straight to 5 million. And people were just coming out of the dot-com meltdown, and it was kind of time to get the party started again on the consumer internet, and so it was just a good time to try something like that.
So speaking of bubbles and meltdowns, so you know there's a lot of talk that we're in this bubble right now, and a lot of money going into startups. I mean, as I talk to some of the companies that I work with, you know, the velocity of money being thrown at them is pretty high right now.
Pretty crazy.
Maybe I don't know historically at the highest level ever, but it's pretty crazy. So, you know, what's your take? Are we in a bubble? If so, what kind of bubble? You know, what happens as a result of this? Any prognostications you'd like to make?
Well, I've seen a couple of things happen that have surprised me. First of all, the amount of seed deals getting done is just extraordinary. And a good buddy of mine, Josh Koppelman, over at First Round Capital, we talk about this. Like, I feel like we're a couple of old men now, but you know, back in 2005, I doubt there was $50 million of organized micro VC capital. And I think now it's north of like $3 billion. But then you also have Google angels and Facebook angels and Twitter angels and all these folks running around with money. So actually getting a seed deal funded is pretty easy. You know, you could argue trivially easy. And I think one of the problems that that's created is that a lot of guys who raise seed money super easy, super fast, they don't realize, you know, like Josh has a good metaphor for it. It's like going from, you know, Little League baseball to now you're on the pro baseball diamond, you know, when you raise your next round. And so some people are getting, I think, a false sense of confidence because I don't think any more A rounds are getting done now than were 10 years ago necessarily. And then the other part of the market that I just find even crazier is the number of companies raising more than $40 million. So I think that Thomas over at Redpoint I think he had a post that said that there was a greater than $40 million round raised privately every business day on average in 2014.
Unbelievable.
And there were fewer than that IPOs that raised more than 40 million from 2001 to 2014. And so that part of it's just hard for me to imagine that there are 15 times as many awesome companies over the next 15 years. And so, you know, something's going to have to give on those companies. But I don't think like, I think you probably remember this too, like in '99, the illusion was real, right? Like people were having debates about when is the NASDAQ going to pass the Dow, and nobody was saying never. It was a range between 2 weeks and 90 days. So I don't think it's like that. I don't think it's broadly hallucinogenic the way it was in '99. I just think there are pockets of craziness, and then the rest of it I think is pretty rational.
No, I remember, and even in those days, like I don't know if you remember the market caps of the companies you were in when they went public, but like if it was worth $300 million, like that was a big deal, right? And like I was trying to think back when billion sort of entered the lexicon.
Yeah.
Like for private company financings, like that is a relatively recent phenomenon. Like I think it goes back just a couple of years, right? Like with the Facebooks and some of those companies. So different world. But I think you're right. I think it's not a public market, craziness as much as it is the Series A crunch and all these seed deals looking for a little bit of capital in their A rounds, right?
Yeah, and I think there'll be a lot of corrections in some of these pockets that are overheated, but to me it's just kind of the circle of life, and just that's how it goes.
It also makes hiring really difficult because everybody wants to be a founder.
Right.
And so I say there are 1,000 2-person companies running around, and instead there should be more 10-person companies, right?
Yeah.
And make it easier for all of us to hire. Yeah. Well, we'll see what
happens.
See what happens. So among other amazing accomplishments, you're the guy who coined the term Thunder Lizard, right?
Yes.
And
not everybody thinks of that as an accomplishment, but I'll take it.
I'd put it on your resume. I definitely would. And the idea of a Thunder Lizard is these rare companies that you like to find and invest in. So maybe talk about, I don't know, what year did you coin that?
1997.
Oh, wow. Yeah. So a long time ago.
Yeah, it's funny. All my friends from Austin, Texas who were at Motive are like, there's nothing new about this. This is all recycled content.
He's been talking about it forever.
Almost 20 years old.
We all reuse our content all the time, right?
So that's right. That's the content business.
When your kids start telling you, Dad, we already heard that story,
then you know it's working.
Yeah. So what's changed since when you started talking about Thunder Lizards and you founded a firm around that concept, right?
Well, and it's funny, on some level, the more it's changed, the more it's stayed the same. And so, the idea of of Thunder Lizards was if you look from a meta perspective, 10 companies usually in a given year create 97% of all exit value.
Wow.
So, this year there will probably be about 30,000 tech startups, and still 10 of them will create 97% of the exit value. And interestingly, usually the best company of the year creates more value than all other tens of thousands combined. And so Facebook was created in 2004. It's worth more than all other companies started in 2004 combined. Twitter was started in, depending on how you count, 2006, probably more valuable than all companies started in 2006 combined. And so, it's not just that the top 10 create 97%, it's that the number one usually creates more than 50% of everything.
Wow.
And so what I was trying to get across with the idea of Thunder Lizards was this idea that there's this tiny exceptional few companies that are these capitalist mutations that seem to appear out of nowhere but that are hatched from these radioactive eggs. And so I thought, Godzilla was kind of a good metaphor for that.
Sure.
So, Godzilla, for those of you who aren't familiar, was hatched from radioactive eggs, swam across the ocean, merged with an attitude, and started to destroy cities and stomp on cars and eat trains like they were sausage links and blow fire on buildings and swipe holes in things. And I was like, yeah, that's what I'm in it for, is to find those. And so, when I was at Motive, I was like, we're going to be a Thunder Lizard. And then when I became an investor, I was like, I'm a Thunder Lizard hunter, and so that's my job.
So how has it changed? Since then, you're still looking for these
pretty much
mysterious creatures.
I like to say that my job is hard, but it's not complicated. It's find those companies, and interestingly, I think it doesn't really matter. I sort of like to walk on the wild side and invest crazy, early, risky, sometimes even illegal. And then, other people like to do late stage, almost public kind of stuff. But I think it doesn't really matter whether you're early or late. If you don't have a strategy to get to those top 10 companies, I don't think you are really in the venture business.
Yeah.
You may be doing venture capital, but you're not about to make money for anybody.
Well, so how do you find those Thunder Lizards? What's the secret other than ask Ann to go do it for you?
Well, I think part of the secret. Well, I can't really tell Ann to do much. She tells me she calls me into the principal's office all the time.
She lectures you.
Yeah. But I guess. Well, I like to say that one thing that's probably true is it helps to get lucky in the first 5 years. And so I don't think I've met very many venture investors or angels who have a big reputation, have done well, who didn't have some major hit in their first 5 years.
Yeah.
And so I think that luck has a sort of a feminine goddess-like quality, and so I worship the goddess of luck. And so I never point to my own virtues before I thank the goddess of luck, because I don't want her to give it to somebody else and think that I was ungrateful. But I think that some of what I look for exponential companies, and so some ideas feel truly exponential, whereas some companies are sort of like reasoned by analogy and sort of they're straightforward, but they're more of a linear thought process than an exponential one.
Got it.
And so like maybe a good example would be, I can think of two. One is Twitter. So Evan, when I met with him to talk about Twitter, I'd invested in Odeo. It had gone out of business. He gave me my money back. And I said, I want to put money in your next company. And he says, well, I think I might have one. I'm going to call it Voicemail 2.0 or Twitter. And I said, okay, what does Twitter do? He says, you say what you're doing. And I'm like, well, then what happens? He's like, that's it. 140 characters or less. Oh. And so I said, well, Ev, why do you think this is a company?
Yeah.
Much less even a product.
Yeah.
And he goes, well, before Odeo, I did Blogger, and 1 million people wrote blogs. And so I figure that if people can do microblogs, we'll get 10 million people to do that. And if that happens, then the burden of proof is on the people who are negative. And so, that's kind of an exponentially reasoned kind of approach. Elon Musk with SpaceX, he doesn't say we're going to be a better, faster, efficient NASA. He says, 99.7% of the cost of a rocket is the rocket and 0.3% is the fuel.
Right.
And so if you make reusable rockets, they'd cost 100 times less for space travel. And so I tend to like entrepreneurs who have these exponential ideas, and usually they sound crazy at the time you have to decide to invest. But if it's not exponential in its nature, I eliminate it immediately. And I probably 1 in 20 ideas I get are exponential. And so for me, it's largely a process of elimination. And then I've got a crazy set of exponential ideas in front of me the rest of the year, and I try to go through them and meet the guys.
That's pretty good. I like that.
Yeah.
All right.
That's my story, and I'm sticking to it.
There you go. So if you've got an exponential company,
that's right.
AKA Thunder Lizard, he's ready to hear from you.
That's right.
All right. Well, let's see if we can help some people out, and we'll dive into some questions here. So the first one is from Michael. It says, your site says that you invest before traditional VCs are ready. This sounds risky. What secrets do you know about picking winners early? We talked about a little bit about that. What different methods do you use other than traditional VCs? Can you describe what your picture of a perfect founder startup looks like? How is it different from the traditional VC's image? So we just covered some of that, I think. But
yeah. So I think there are a couple of observations. I think that the later you invest, the more you think about risk. I don't really think about risk.
You don't care if it fails.
Every startup starts out dead and has to prove it's alive, right? So you're not you're
investing in dead companies.
Yeah, they're
nice.
Dead and have to prove they're alive. So I look at my job as more about thinking about what could go right and how we could be lucky and how to help the company multiply its luck. And so one of my LPs has a great expression that I've always liked, that a lot of startups is about putting yourself on a lot of the right roads to get hit by the lucky truck. And so when when I invest this crazy and early, and literally a lot of my pitches, the founders are like, we're not sure if this is legal, or we're sure it's not legal. When you're getting that kind of a pitch and it's exponential, you're really looking more for the potential energy of the idea. Right. It hasn't been converted to mechanical energy. It's very uncertain. So for example, we invested in Twitch when Justin Can walked into a coffee shop with a camera on a baseball cap and a backpack, streaming his live video.
Right.
And that's just kind of crazy, right? But I thought live video will be a thing someday, and
it's back, right?
Let's give them some money, see what they do with that, right? Whereas if it makes sense and it's too straightforward, a lot of times there's a whole bunch of competitors and things like that. So I tend to like wacky, controversial, but potentially exponential ideas with very passionate, authentic founders who you say, I can't imagine them doing anything but this idea. And then I don't worry about risk too much. And Floodgate's system internally is built around not trying to be too consensus driven. So, if Ann and I had a voting system, we'd vote no against some of these crazy ideas, because some of them really are freaking crazy, right? When you see, Airbnb, they came in, unfortunately we didn't do that one, but they come in with cereal boxes, and they call it Air Bed and Breakfast.
The Obama
O's and McCain Captain. It was crazy, right? It was crazy. And so we do it differently. Ann has a checkbook, I have a checkbook with each fund, and we just say, just win, baby. And we all know how much we invested and how much it's worth, and we get to stay if we multiply our checkbooks enough, and we don't if we don't.
All right.
Yeah.
Well, and I think that's very different than the traditional VC model,
yeah,
right?
yeah.
So, So, Michael, I hope that helps. We've got another one here from Naveed in Austin, Texas, your hometown.
Yep. He's, in fact, one of the guys I backed. Fits the Naveed, I think. Lalani?
Yeah.
All right.
So, all right, Naveed. So I hope you're watching right now. It's your big moment. Please share some unexpected characteristics you have observed in entrepreneurs that have gone on to a high level of success. Exclude typical traits like courage and resourcefulness. So it sounds like crazy might be one of them, as we were just discussing. But what else?
Well, I would say an element of naughtiness. And so, if you've done angel investing, you've probably experienced this sometimes, where the founder is like a little bit hard to deal with, but not in a bad way necessarily. They're it's because they're a good negotiator and they know how strong their hand is, or they're good at bluffing or whatever. Or they don't mind scraping Craigslist, or they don't mind getting a cease and desist letter from somebody. And you can go too far with that.
Yeah.
But in hindsight, I can't think of a truly great entrepreneur who didn't push the envelope just far enough, because to truly disrupt the world and change things, you got to ask for some forgiveness.
Absolutely.
And so when I get a little nervous sometimes, to be honest, when the entrepreneur cares too much about what I think, cares too much about is he going to be unimpressed by what I just said.
Yeah.
I tend to like the folks who sort of, they know what they're in it for, and it's like, I'm riding shotgun and they're driving.
Get on the train or get the hell off. Right?
And I want them to be somewhat of a risky driver, right? Because you're not gonna win the race if you don't take some risks.
Sounds like fun.
So I've had a range of investments where some of the entrepreneurs were naughty and they ended up too naughty and it got crazy, and I was like, oh, I don't like it that much. But whenever I say I'm never going to invest in somebody that crazy again, I'm reminded of the other crazy that works. And so, it comes with the territory.
So how many of your founders have been in jail during the time you've been an investor?
I don't know. That's a good question. I don't know if any of them have gone to jail, but certainly many of them have been sued and declared illegal and shut down. The guys at Outbox got shut down by the Postmaster General.
Oh, that's right. I remember that.
So, it's like, we take our risks.
Well, and I don't know if you're in Life 360, but they got sued and a patent troll, right? And Chris beat him, which is awesome. Like, I love that he didn't give in, and he sent kind of a obnoxious response back that later showed up in court, which I thought was pretty funny. But
early days of Lyft, they got sued pretty much every town they operated in.
Yep. And that's and now it's sort of like people can't imagine their lives without having that capability, right?
Yep.
So,
Yep.
All right. Well, there you go, Naveed. Hope you're doing well down there in Austin. Here's a tweet that came in from actually it's from a friend of mine, Hong Kwan. I'll give Hong a plug because he's a good guy. He's got an electric bike startup called Karmic Bikes that is on Kickstarter, and they just kicked in like 7 days. They raised their $200,000 or whatever it was. So. Go check them out. But Hong's question, of course, is, does Floodgate invest in hardware startups? And his hashtag is Mechatronic Thunder Lizard, of course. So what about hardware startups?
Well, we do. We've never had a huge outcome yet. One of them was really unfortunate and kind of unlucky. We invested in this company called Player, which Google Chromecast basically created a product almost exactly the same. And charged $30 for it.
Yeah.
And so the place that I see a lot of the hardware startups fail is they don't understand how important it is to have high margins. And so what they'll do is they'll say, well, I want to get market share, so I'm going to price it near my costs and build market share. And I think margins in some ways are a proxy for truly differentiated.
Yes.
It's not accidental that Apple gets crazy high margins for their product. It's because they're differentiated. And so I think that a lot of entrepreneurs tend to shy away from having prices that would give them high margins, but perhaps that means they don't really think that their technology is truly that different, or their product's that different, or their experience is that different.
It might be 25% better or something.
Yeah, and so I have a hard time with a hardware startup with a low margin. Now, I can be convinced and talked out of it, but traditionally, I don't see that working so well.
Well, and they don't necessarily fit the exponential model either, right? Like, hardware has to come off the line, right? And you got to build one widget at a time. So
and it's changed somewhat, right? The ability to stamp out hardware products in massive volume is certainly different than it was 15 years ago.
Yeah.
But like even Fitbit, right, which is about to go public, I bet you that if you were to analyze their bill of materials, their margins are actually quite good.
Oh yeah. I bet they are. Yeah, that's another great success story, right?
I wish I was in that one.
Oh yeah.
And by the way, I'd like to say we're good at hardware, but somebody who I think is quite good in the early stages would be John Callahan over at True Ventures.
Sure.
I think he's pretty experienced and smart in this area.
Absolutely, and Jeff Clavier as well, who's
Clavier's
in Fitbit.
had some good ones.
I think both those guys are in Fitbit. So, all right, Hong. Well, good luck. I hope people keep coming to your Kickstarter
and buy those high-priced bikes.
Yeah, exactly. They're pretty good. It's like $1,800 for like 30 miles of range.
High margin, I should have said. High margin.
I don't know about that. I don't know his bomb, but I'll bet you he factored that in. All right. So here's an email from Bobby. Our lead investor thinks it may be time to bring in a more experienced CEO, and the founders don't agree. Any advice for how to handle this? So this happens occasionally in startups, as we all know. So what you've probably seen a bunch of these. What's your take?
Oh, it's so hard. In general, I have not seen it work for the CEO to be replaced involuntarily. I'd say 9 times out of 10, when you replace a CEO involuntarily, the venture capitalist just makes the company worse.
Totally agree.
And so, when I think about it, there are times where I think that the company needs a different CEO, but I've come to the belief that part of my job as a VC is to help them see my perception of the truth. Right? By the way, that doesn't mean to win an argument. That doesn't mean I'm right, they're wrong. It's just that I feel like I'm doing a good job if they truly understand my perspective. And they can choose to disagree with it.
Right.
And if they disagree with it and stay in charge and run the company off the rails, they're going to suffer even more than I am. And so we've had situations where the CEO didn't want to change, and we ultimately convinced the CEO. If I was looking at it through the founder's perspective, I would say, first of all, does the investor have a point? Now, perhaps not. Like, I think a lot of investors knee-jerk assume that the CEO should be replaced, and they're wrong, and they don't support the founder enough. If the disagreement persists, I think you're probably better off selling the company. Either finding a way to get rid of the VC, or selling the company.
Well, getting rid of the VC is very hard, typically, right?
Usually, it's very hard.
Yeah. I mean,
and for better or worse, I think a lot of founders don't reference check their VCs well enough.
Absolutely.
And they don't realize you can't get rid of them. Or, once you got them, you can't get rid of them. Yeah. I like to joke that I like to invest in people that I would enjoy getting in trouble with, because you are going to get in trouble together. And it surprises me how few founders recognize that they're going to get in trouble a lot. And is that investor the kind of person I want to get in trouble with?
Yeah.
Where the chips are down and it's just like ugly and there's bullets flying everywhere and it just looks like there's no way out. Is this the person I want on my board?
Yeah. Well, and I think having been through that myself, I think one of the things that a little bit of grass is always greener on the other side, but the VCs underestimate the impact that founder has in other ways, right? Like in terms of like product vision or sort of the soul of the company, and that is almost impossible to buy elsewhere, right?
Yeah.
You might get the gray-haired CEO to come in, and maybe margins go up, or the trains run a little bit more on time, but you don't have anything to sell because the soul left, and it's really hard.
I mean, vision can't be hired, right? Everything else can be hired, but you can't hire vision, and you can't hire sort of an unconsensus and right point of view about where a technology is going. And so you lose that, you just lost the whole premise of the company.
Yeah.
And so I think it's important to do everything you can to be good to founders. And some people say, well, what if the founder turned out to be a bad guy or bad gal, and I sort of look at it like I didn't do a very good job picking the right opportunity.
Yeah.
And so fundamentally, I kind of think if I'm willing to pick this company, I need to do everything I can to make sure that the founders and the sort of the lightning they trapped in a bottle stays in the company.
Yep.
And
which is why you invested in the first place, right?
Yeah, exactly. But if I invest in somebody who doesn't turn out to work out, okay, well, I just need to be a better investor.
Yeah. That's good advice. So, Bobby, hope that helps. I would go and talk to other startups and people who have been through that before, and investors, and just keep working on it. And I hope it works out for you or whoever's involved. So we're about halfway through, so it's time for you. You can take a break.
Okay.
Have a beverage or whatever,
awesome.
And I get to talk about our sponsors. So, we wouldn't be able to do this show without the support we get from our amazing sponsors. We have 4 for this season of FounderLine: Oric, Square One Bank, Accretive Solutions, and Ustream. So let's start with Oric. Mitch Zuckley over at Oric is a great guy. I've worked with him on multiple companies, and he's one of our founding sponsors, and really one of the reasons we're here today. And I always tell startup founders and CEOs, one of the biggest things you need to do when you get going is to find a great lawyer. And yes, they're going to take care of the legal paperwork and do your financings and hirings and firings and all that sort of stuff. But more importantly, they're going to be one of your most trusted advisors. And so you really need to find somebody good who has seen way more transactions than you'll ever see, and just sort of knows, hey, this is standard, this is not standard, you should push back here, you shouldn't push back there. So Mitch and his team are great. You can find out more about Oric at their website. It's oric.com. Go check them out. Next, I'd like to thank Square One Bank, who's a new sponsor this season, and I've worked with Sam Baumick and Lori Lumenti-Gardi over there for many years, again through multiple companies. And when you're building a startup, you want to have a great financial partner who can take care of you. And when Mike gives you $1 million or $2 million or whatever, you want to be sure it's safe, of course. So obviously you don't put it in your mattress.
Or auction rate securities.
That's right. That's right. Try to avoid those in general. But you also want to make sure that you have some of the conveniences you can get. So things like online banking, or stop using your personal credit card and get a company credit card in case anything ever happens. You don't have $20,000 of outstanding credit card debt on your personal account. So the team over at Square One Bank can help you out with all that sort of stuff. You can find out more about them at their website. It's squareonebank.com. It's square and the number 1 bank.com. Third, we have Accretive Solutions, and they are the leading business outsourcing company in Silicon Valley. And Martini Niganol is the person who I've worked with. She's been my interim CFO before, and when I first started working with them, I'm like, what is business outsourcing? That sounds like one of those nebulous terms. It turns out it's your interim CFO, it's your finance function. Accounts payable, accounts receivable, they'll do payroll for you, all this sort of stuff that you have to do in order to be compliant. But you don't want to spend a ton of your time like making sure that the books are balanced yourself. You got bigger things to be focusing on: hiring, strategy, making sure the product's getting built, all that sort of stuff. So get a great partner who can help you out with that sort of stuff and sort of relieve you of the burden of sort of the day-to-day, managing of the numbers. And they've been great to me, very cost-effective as well. And so you probably don't need a full-time CFO and controller right away, maybe never in many cases now. Go check them out. Their website is as-bos.com. It's Accretive Solutions Business Outsourcing Services, which is the as-bos.com. And then finally, I want to thank Ustream, another founding sponsor for us. When we first had the idea for FounderLine, we went to Brad Hunstable, who's the CEO over there, and said, hey, we're thinking about doing this. Can you help us out somehow? And they were very supportive, wanted to help out the entrepreneurial community and get this sort of service out to the startup world. And so they've been great to work with. If you're a company and you need to do some company meetings with remote offices, or maybe your employees are around the world, maybe you're doing some sort of public event that you want to stream, they can take care of everything for you. The software is great. We use it obviously here to do the show live, and you can find out more at their website, which is ustream.tv. So that's paying the bills. Cool. And we'll dive back in and see if we've got some more questions. We got a bunch more. So let's see. Let's start with Mikey. And Mikey writes, in light of recent news regarding Secret, do you think founders should give back investors money if a product is not working out, or use it to create another company, similar to how Evan turned Odeo into Twitter? So you lived through this. I don't think you necessarily demanded the money back, right? But what do you think with some of this stuff?
Yeah, well, I think that it's important to distinguish between, say, a seed round and a larger sort of more scalable A or B round, right?
Okay.
So like, I don't know, like my recollection is that the Secret round was something like $15 to $20 million, and the founders took some money off the
25,
table.
I think.
25,
yeah,
and they took
6.
They took an amount of money that was suggested that they'd already been successful off the table. Okay,
yes.
So that's like, I don't even know what to say about that, because that's not the neighborhood I live in. I mean, I have some thoughts, but I just shouldn't wade into that probably.
Okay.
But I've had several situations where we'll invest in a seed round. Let's imagine it's a $1.5 million round, and the company is almost out of money, and maybe we've got a couple months left of runway, and we're having a hard time raising money, and the founder says, I can't lose your money on this thing. I don't want to be known as a founder who loses money, and so therefore I have to raise a Series A from somebody. And my answer to that has always been, look, I don't win by optimizing the losses. So I win when a company makes 100x or more.
Right.
And if I invest in enough of those companies, it doesn't matter what happens to the $1.5 million seed rounds that don't work out.
Right.
So what I always say to the entrepreneur is, okay, you know something today you didn't know 9 months ago. So knowing what you know now, would you keep playing through this game, or would you have not played the game?
Yeah.
And if the answer is I wouldn't have played the game, you're way better off just stopping. Because once you raise a Series A from somebody bigger than us, they're not going to have that same attitude, right? Like $5 to $10 million, totally different conversation.
Yeah.
And so I'm like, look, a startup starts out dead and has to prove it's alive. And so if we don't think we've found any proof of life, welcome to my neighborhood. That's seed investing. And your time is more valuable on something you think might work than worrying about whether I'm going to be mad at you for losing $1 million.
Yeah. Yep.
So I usually encourage people to give the money back, not because I'm a fiduciary, but because it's like your time is the most valuable thing you have, and you should only be using it on things that you think are truly meaningful and awesome.
Yep. I like that. So Mikey, hope that helps out. Let's see. This one is from Marcus. In your opinion, what do most VCs tend to overemphasize when analyzing a startup, and what do they tend to underemphasize?
I think they tend to overemphasize risk. I think in today's world, there's a big overemphasis on traction, existing traction. I think there tends to be an overemphasis on founders that make them comfortable.
Like investing in people who are like them?
Yeah, or people who just seem to kind of have the ooze factor, or just seem credible, and I'd give them money. They're backable, safe.
I see.
And I think that's good, but to limits. I think there has to be an element of, I wish we had invested in Viva, but one time I met Peter Gassner, and he said something that has always stuck with me, which is, every startup has to have one thing about it that has a way less than 50% chance of coming true, and that could cause them to go out of business if it doesn't come true. But if it is true,
then it's
100x.
Yeah.
And so, like, to me, that's what being a venture capitalist is about, is saying, clearly there are leaps of faith here. And there are even leaps of faith that are far less than 50-50 of coming your way. And those leaps of faith, maybe you're going out of business leaps of faith. But, you know, if the returns on that leap are wildly asymmetric, that's what I'm in the business of doing. I'm in the business of backing those kind of people.
Yep. All right. Well, Marcus, hope that helps. Let's move on to Leslie. What impact does having 2 women partners in your firm have when analyzing female founders? And I would extend that to say, what impact does it have on anything, right? I mean, Leslie's is about female founders, but you know, that's fairly unique for the business, right? I mean, most firms might not even have a female investing partner.
Yeah, people joke that I'm the token dude.
I had a management team at Presto, and it was like, I think it was like 5 out of 6 were women, and you know, it was like a band, you know, like I was like the lead singer, and you know, they were in charge, you know.
Yeah, this is a tricky topic to wade into, and dangerous in many ways.
But you like danger, you like trouble.
I like danger, I like crazy.
Let's not get arrested, but let's.
So like, okay, this may be a long-winded answer, but I think it'll get at some of the points. So when I started to see that 500,000 is the new 5 million, I started to notice that a lot of people who were pitching me were women and minorities. And I was like, why is that? I wonder why that is. And my belief was that when it costs less money to try an idea, more people can raise their hand and say that they're entrepreneurs. It's not just who is anointed by Silicon Valley VCs.
Got it.
And so one of the reasons that Ann and I started Floodgate together was I was like, we need to try to be gender balanced from day one. And I think that a lot of people sort of miss this. Like, you know, the North Pole and the South Pole have different magnetic charges. And, you know, like a battery, to create energy, you have positive and negative terminals. And so, like, I've always had this belief that sort of businesses of the future will figure out how to reconcile sort of masculine and feminine energy in a way that's more powerful than the way business of today is done. So, like, you know, we're not gender balanced in the sense that we're trying to create some type of social justice or trying to right some wrongs or whatever. We just think that 50 years from now, most great companies will reconcile those two kinds of energies better than they do today. And so what I see happen inside of Floodgate is it kind of manifests itself in, you know, our partner meetings just aren't very testosterone driven. It's sort of like, you know, I'll make a point and then 30 seconds I'll be like, you know what, actually, I don't think I knew what I was talking about when I said that 30 seconds ago or whatever. And so there's kind of this, you know, when you balance sort of the male and female energy the right way, there's sort of this, look, it's all about just figuring out what the truth is, and let's not worry about whether I said something smart or dumb in the meeting for the rest of the day.
Yeah.
And since I think investing fundamentally is about truth seeking, you know, I think that that's a big advantage. And then I think in terms of how we evaluate female founders, I think that we probably get pitched by more female teams, female-led teams. So I think we just have more to look at. But I also think that, you know, having sort of that feminine sort of side of decision making, you know, more than 50% of now internet users are women. And so I think that, you know, on some level it does take one to know one. And so I just think that we just have a broader spectrum of understanding of different businesses that walk through the door.
Yep.
And, you know, Ann is way more technical than I am, so it's not like Ann just does e-commerce and shopping kind of stuff. She also does radical science and very deep stuff that I don't understand. But I would say that it's sort of the having that balance and mix of energies that really helps in decision making and how we treat each other.
Yeah. No, I think it's great. And I think it's really important because you probably make better decisions as a result, right? You have more diversity around the table, whether it's gender or anything else, right?
Yeah, that's the thing. Like, I just think it's the natural order of things that the opposites, when they combine in the right way, create value and multiply the size of the pie. It's true in negotiation, right? If you and I are negotiating, the value gets created if what you care about is different from what I care about, because then we can trade what we care about less for what we care about more.
Right.
And so it's the differences in this world that when they're harnessed correctly, that's what multiplies the pie.
Yep.
And it's true in physical, natural law. It's true in business. I just think it's just true in general.
It's great. Well, Leslie, hope that helps. By the way, I forgot to mention, if you want to send us more questions, tweet to @FounderLine or email help@founderline.com, and we're running through them as fast as we can. Gary says, if a thunder lizard and a unicorn had a baby, what would it look like?
Yeah, God only. So
I don't know if we want to think about that very much.
I'm not a unilizard. I don't know.
Exactly.
I'm not sure.
Exactly. Unicorn is. I don't know. Unicorn is kind of like going out of favor now. So everyone's.
Well,
talking about...
you know what? First, so in total defense of Aileen Lee on this one, right, who is credited with coining the term, she writes an article in TechCrunch, and it's totally supported by data. And all she really did was say, I wanted to understand what billion-dollar outcomes look like.
Yeah.
And, nobody had really gathered the facts or data about that. And so she does. And it's not Aileen who hyped the term versus not. It's like people took the term and sort of ran with it and dumbed it down and hyped it up and projected it into other contexts. And I feel like a lot of sympathy for her on this, because like I did this speech once at a Founders Institute about pivots. And everybody's like, that speech was awesome. Pivots totally makes sense. But then everybody started using the word pivot. Now, like pivot, just people hate the word. But but so like sometimes the word just like gets appropriated by other people.
Well, but it in this case, Unicorn captured, all she wanted to do was put a label on billion-dollar company, right?
Right.
And understand what was going on, or pivots, name it. And like all those, like pivots have been going on forever, right?
Yeah.
It's just that they got named at some point.
Yeah, and we named it, and then we said, okay, this is a pivot defined, and this is when you do it and when you don't do it. But then people just like, whenever they just said, I want a mulligan, they just said, okay, it's a pivot.
Yeah,
so
exactly.
Whatever. Yeah.
All right. Todd sent an email. When you meet a founder for the first time, how quickly do you know if you're going to invest? Do you get a gut feeling in the first 5 minutes and then verify? What are the key factors here? Is it market size, team, something else?
It's funny. I would say that at least in my case, I'm probably the most emotional investor at Floodgate. I would say that the best companies I've invested in were the ones I decided the quickest.
Like you just something.
Just
snapped.
something.
What
just something.
is it? The personal connection? Like, I like this person. I want to go to war with that guy. Or
there's an element of that. Sometimes I'll just say, this is just a great idea, and there will be other times when I just get this feeling of my spidey senses tingling, and I'm like in the room, and I'm like, I just met someone who's going to be famous someday, And so, what I've learned is that when I take a long time to decide, I'm really trying to talk myself out of doing it. And so I've learned over time to sort of trust that spidey sense that that wow, something just hit me. I got that emotional kind of feeling, and now I need to do some diligence to make sure that I'm not in lust, that I'm in love and not in lust.
Yes.
But
yes.
But that's really why I'm doing the diligence, right? When I'm doing the diligence, usually it's to cope with my own ignorance and emotion. But usually I've kind of decided within half an hour if I want to do it.
That's pretty amazing.
Yeah.
So that first few minutes is pretty damn important, huh?
Yeah, I'd say so.
And I remember this, coming out of school as an engineer, I was very analytical and I used my head. And I remember in the first couple years of business, like someone told me, you just got to trust your gut. Like even though your head might be saying something, what is your gut telling you? And I think that's something that young entrepreneurs underestimate. They probably know what the right answer is if they just thought about it for a second, and not analytically, but just down here, like what's your
and the young folks often, well, all kinds of folks, very often they try to outguess what they think I'm going to be looking for. And I always like to say to entrepreneurs, be awesome and syndicate the truth. Right, and it's like that's really all there is, right? And so if you don't have any traction, say it, right? Like I'm going to figure that out, right? And so like having some convoluted slide where I'm just like, what's your traction?
Yeah.
Like just you're way better off saying I don't have traction yet, but here's what I'm working on, or here's why I'm pitching you before I have traction.
Yeah.
because I'm going to figure it out anyway. And so, like, if I have to pierce through the veil of them hiding it from me, it's not going to go as well as if I know.
Strike one right there.
So I just, like, the first few minutes, I want to know, what do you do? What have you proven so far? Why did you start this? And I want to know it in basic monosyllabic, simple words, right? No fancy hackneyed buzzwords.
Yeah.
No guessing what intersection markets I'm looking for. None of that stuff.
Yeah.
I can figure out if there's a market. That's my job.
All right. Well, trust your gut. Let's see. Where are we here? Okay, this one's from Mira. What are some of the mistakes you've learned from? You never make mistakes, so I'm sure. Investments you shouldn't have made, or opportunities you've missed. So,
Oh, God.
what's the biggest company that you missed out on? Was Facebook?
Probably Airbnb.
Oh,
so
Airbnb?
I wasn't in California yet when Facebook happened.
Okay, so that wasn't your fault.
Yeah. Oh gosh. So, like, there's a few that bug me still. Like, YouTube bugs me. I saw that one, but I'd only been in Silicon Valley for 2 months. And so I went and had breakfast with Reid Hoffman, the first time I've ever met him. And I say, hey, Reid, I want to do this YouTube investment. I'm pretty sure you know them because they're PayPal guys. And he's like, hang on there. We just barely know each other. Let's get to know each other and stuff like that. And then he explains to me that they're going to make an angel syndicate and try to invest in them. Peter Thiel and Reid Hoffman and Keith Rabois and some guys. And he said, but you should know we're going to compete against Sequoia Capital. And I said, well, why don't we just try to be friends with Sequoia Capital? It's like, be lovers, not fighters.
Yeah,
and he's like, well, at the time, Peter Thiel wasn't 100% psyched with the Sequoia guys. And he was like, that's not really how Peter wants to roll in this kind of thing.
Ah, got it.
So we ended up losing it to Sequoia. I don't even think I ended up getting in on the syndicate. And it was like watching a hot air balloon drift away. And that one was tough because I saw it. I knew it was going to be huge. And then Airbnb was just crazy. These guys come in, Brian has these cereal boxes. And I'm like, well, I thought you guys are Air Bed and Breakfast, not selling cereal boxes. They say, well, we can't raise money, so we've been selling McCain O's and McCain Captain Crunch and Obama O's.
Right.
And I was like, well, that's an interesting way of building confidence.
That was to bootstrap their.
To bootstrap it
Oh,
because
really?
they couldn't raise money.
So it was like a publicity stunt.
Yeah, and then they decide. And then they describe it. They say, okay, here's the deal. You go to somebody's place and they give you an air bed, and then they feed you breakfast the next day. Air bed and breakfast. And I was like, okay. And I was like, well, what's your distribution strategy?
Yeah.
And he goes, check it out. We're going to blow up next week at the Democratic convention because there's not enough hotel space. And I'm like, okay, that's great. But, like, what's your distribution strategy?
Yeah, after
well,
that.
we're going to blow up at the Democratic convention. So to our credit, like, Ann and I are like, that's crazy, but it's kind of crazy. So we should talk to these guys some more. So we're like, week after you get back, let's talk some more. Because it's kind of crazy, but kind of cool. So they're like, okay, great. Well, they blew up at the Democratic convention. Sequoia Capital just swoops in, takes the round, done.
Wow.
And that was another one.
So
just
you could have had it
hot
if
air
you
balloon drift away.
a little quicker.
Yeah,
huh?
that one was tough.
Yeah,
that was rough.
Well, I remember when I first heard it. I forget where I was. It was on stage somewhere. Like it was not even that secret, and I just thought it was crazy. I was like, I don't want to sleep on somebody's air mattress and in their house, like
And there had just been the Craigslist killer.
Oh.
And so there was all this, it just seemed wacky. And there were other couch surfing deals at the time. It looked like a couch surfing deal. But I mean, to our credit, we were still interested and engaged, and it just, and then I passed on Zynga. I didn't think that Mark Pincus was a gaming guy. And so I didn't do that one. That one hurts. But I'd say those are the and the funny thing about this business is for all the ones that you do, there's gonna be ones you didn't do, and I kind of look at it like as long as I'm seeing most of the good ones, you're always in the game.
Yep. All right, let's keep going here. We got a couple more. This one's from JC. How closely do you work with a company you've invested in? What are some services you provide? So, there's a lot of talk about Andreessen Horowitz, and they have, hundreds of employees helping out people. Seed stage firms are a little bit different, right? It comes down to, a handful of people usually. So, help JC out here.
Okay. Well, I guess the first observation is, like, I remember when I was a founder, I liked my VCs, and I had good ones, right? Like Jim Breyer from Excel, and John Thornton and Bill Wood from Austin Ventures. But to be honest, I didn't think about them that much. I just had real company stuff to do, right?
Yeah.
And you know what it's like.
You're busy.
You're recruiting employees. You got to make the number. You got to ship the product. You got to hire people. Like that's real company stuff. And so the VCs were very helpful. But I always sort of look at it like if I, as a founder, had asked the VCs to do a bunch of those things, I would have thought I was being weak sauce as a founder. And so as an investor now, I try to say, how can I be the person that I would have wanted if I were a strong founder? And everybody, I think that part of being successful in this business is knowing where you add value and where you don't, and being very intellectually honest about that. And so with most founders, what I try to do is I try to say, okay, there's technology, there's product, there's company building, and then there's category definition. And I call that like a value stack. And as you go farther up the stack and do a good job, you multiply the value more and more of the company. And so I try to work with a founder to understand kind of what are our assets and liabilities at each part of the stack, and how can I help them get people surrounding the company that are going to help them get all those elements right in the first 20 employees. Because if you get that right, you sort of get set on a path. So I think there's that, and then I guess the other thing that I've learned is that there's a lot to be said for being there when the chips are down. And so there are going to be times as a founder where it just seems impossible and that there's just no way out. And I've learned that they probably don't appreciate it when they're evaluating me as an investor. But I think a lot of the founders that I've worked with in hindsight have said that was the part that meant more to them than they expected, was like, what was it like when it seemed impossible, there was no way out, and we had to MacGyver a miracle. That sometimes you need an investor there to say, we've got this. Or, what are you talking about? We're not going to raise the money. Fucking A, right? We're going to raise the money. We're doing this. And so,
Totally agree.
It's like, like at a car race, you can't look at the pins. You got to look at the path through the pins. And like being that way for the entrepreneur all the time can be helpful because, when you're an entrepreneur, you just get told so many times that this is stupid, it can't work, you have no chance, and the world is a pretty inert, change-averse place.
Well, and I remember, I don't know if you know Paul Martino from Bullpen.
Yeah.
So Paul's a great guy, and he was our lead investor for Tello. And I still remember he was always positive, and I think one of the keys to that, and it meant so much to us as a team, just because we've all had investors in the past who kind of come in and they think tough love is the right answer, and it's like, we're busting our asses here. Like, these things aren't working for what, maybe it's because of us, maybe it's the market, who knows, but we know the shit's hitting the fan. We don't need you to tell us the shit's hitting the fan. We need you to help us get a shovel, And I still remember how Paul was just, and I think because he was an entrepreneur. And I always tell people, like, the best investors, it's not necessarily true across the board, but many of the times the best investors are former entrepreneurs. They've been sitting in your seat and they know what you're going through and that you're up all night or whatever, and they try and help you out, and they might be secretly thinking, man, this thing's going nowhere, but they come in and cheerlead at the appropriate moments, right?
Right. And you never know, like, time is your ally, right? Like Chegg, we talked about earlier. We were out of business, right? And we had no money left, and we wanted to try this one last gasp textbook rental idea. Had to put in another $250,000 to try it. And it's like, you just, sometimes you're just like, this company just isn't ready to die, and we just have to just leave one last time, grit your teeth, dig in, let's go.
Well, and that's what happened with Tello, actually. We had kind of a Hail Mary, and somebody caught the ball.
Sometimes it happens.
Well, unfortunately, we're out of time. I hope you had fun.
Always.
It was awesome. So thank you. And if you want to follow Mike, you can check him out on Twitter. His handle is M2JR. Mike Maples Jr., I guess, is what that stands for. So go follow him. And is there a Floodgate handle as well?
No, right now we're just doing it as individuals.
Okay,
so Ann's Animaniac.
Okay, that's right. Yeah. So tune in next week. We've got another great episode of FounderLine for you. Our guest will be Kirsten Green, who's the founder and managing partner of Forerunner Ventures, who's also an investor in Tello and a great investor. She's invested in over 30 early stage companies, mostly in the e-commerce space, including Bonobos, Dollar Shave Club, and Warby Parker. So be sure to tune in. It'll be a great show. It's next Wednesday at 5 o'clock Pacific time, and you can send us questions in advance if you want to reach out to Kirsten. Thanks once again to our amazing sponsors, Oric, Square One Bank, Accretive Solutions, and Ustream. Don't forget to follow us on Twitter. Our handle is @FounderLine. You can email us questions, help@founderline.com. You can go to the website, check out the videos of previous shows. You can subscribe to email updates. We'll let you know what's coming up. And you can also subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.